This is the video on multiple stochastic trading. We have on our chart, again, an 1100 and a 6000 tick bar chart. When you're using this approach, again, you want to use a fairly good size spread between the two different tick bar intervals. Fairly good size spread. Now, that entirely is up to you. The concept here is that we're going to use two or more stochastics to enter our trade. When both stochastics, when the fast is above the slow on both stochastics, you're going to be looking for a long trade. Opposite, the converse is true for the short trade. Depending upon circumstances, you may not be using a dual or multiple stochastic for your entry. It will somewhat depend on the circumstances, just like it does in zone trading. So our initial entry here, here's the concept, our initial entry will be where both stochastics are now pointing up. Now this may end up costing you a few points. You may not get in at your best potential price using this approach. Of course, this will depend upon when the bar is actually updated and when the stochastic is crossing. Now when you're looking at it on these kinds of charts, you don't see the crossover until the close of the bar. But with our system, because we're updating it intra-bar every 100 ticks, your crossover is going to be much earlier. But again, let's first of all understand the concept. So two stochastics, both crossing, not necessarily at the same time, but both crossing. And when they do, that's when your trade takes place. Now we look for the exit. Just follow the vertical bar here. You're just beginning to turn over in here, okay, between these two bars, as an exit. Or here, as an exit. Then finally up in here. Oh, by the way, yes, there is, of course, a potential here for another entry right in here. The bars are crossing between those two bars, and another exit between these two bars. Okay, so probably right in here. This is very easy to set up, but before we talk about how to set it up, let's take note of a couple of things. When you're setting up the zone of the stochastic, your overbought, oversold zone, don't leave it just at the standard generic 2080 approach. Look at how things have been performing. For example, let's expand this chart out. Now, if you look at where the stochastic is really turning in these instances, it's way above the 80% line. So don't leave it at 80%, move it. All right? Look at where it's turning. Okay, let's get this up here. All right? 90 and 89. 90 and 87. 92. 83. 91 roughly. Okay, So why do you want to leave it at 80? Set up your zones. So just as you would in an actual stochastic here, you're going to move that zone to, say, somewhere better than 85. You might even take it all the way up to 90. Okay? And the same approach would go to your oversold. Look at it. See where it's actually turning before you just set this thing up. Now this, of course, you're seeing this actually plotted on the screen. In our strategy, it's all done mechanically. We aren't going to plot things on the screen, unless, of course, you want to. So, big spread between the two, verify the zones, now set it up in the strategy. So we'll go over here to the strategy. We'll move down to the stochastics. Use the stock, okay, abbreviated. Set that to true. Set up your zones. Let's just say, in this case, it's 10 and 90. Quotation 10, comma 90 quotation. Now that's set up. Now it's just a matter of which stochastics are you going to use. We're going to use a dual approach. Two stochastics. One's at 1100. The other one in this case was at 6,000. Okay? You're done. That's all you needed to do, to use a dual stochastic plus stochastic zone approach. Now you've got your basic settings down. You can further filter that with group reversals or any other approach you might like to take. And once again, when you set this up, you're looking at plotting the results on the tick strategy workspace. So this is just for the sake of reference, to give you the concept. But the actual trades, they're just going to give you a long or a short signal once those conditions are met, rather than plotting stochastics on the screen. You'll just get the signal itself. This will help you to get an idea of where you could expect to get a signal. So if you really wanted to get fancy, you could add, you keep these two charts on your screen, add a third chart. Say, let's just place a third chart on this screen. Let's say this is a 100 tick bar. Don't need too many bars back. Then just add the strategy and set it up. Okay, that's all you have to do. Now you've got that information all three charts on the screen, two for the sake of reference, one actually pulling the trades. You get a visual effect of having the stochastic being plotted until you begin to see how it correlates, and let the strategy just pull the trigger where the confluence takes place. It's a very simple approach, but just another way the strategy can be set up, and you can get very good trades as a result of using a dual stochastic. A single stochastic, not very good. Dual stochastic, triple stochastic. You can go up to how many? You could have as much as 9 different stochastics working at the same time with our strategy. Very simple approach. This is how you do it. All right, so that concludes our use of the multiple stochastic approach, stochastic trading, and we're going to talk next time about the use of other market internals. That concludes our video.